The US gross national debt has blown past $36 trillion, an all-time high. That's a staggering figure, fueling worries about America's fiscal health and its ability to manage such an overwhelming load of red ink. Analysts on Wall Street are on edge. JP Morgan now warns there's a 60% chance of a US recession by the end of this year, as economic warning signs from rising interest costs to policy shocks continue to mount. Are we truly racing towards economic disaster, or is this just fear-mongering? Let's find out. As of April 2025, things seem stable at first glance. Inflation, once running wild, has cooled to 2.8%, the lowest in years, and unemployment stands at a manageable 4.2%. On the surface, things look stable, right? Well, not really. The US government just slapped major new tariffs on dozens of countries, a high-impact policy jolt that risks raising prices for consumers and straining trade relations. And this move is making experts nervous. Your next phone or even your groceries can become noticeably pricier overnight. Why is this such a big deal? Because when tariffs spike, your wallet takes the first hit. Even Fed Chair Jerome Powell admitted that tariffs could push inflation back up, undoing months of progress. Moreover, trading partners are fuming. China retaliated immediately with tariffs of its own, and others may follow, raising the specter of a broader trade war. This is a dramatic shift from just a year ago, when supply chains were healing and inflation was easing. At the same time, the Federal Reserve's interest rates remain around their highest levels in 2 decades, exceeding 5%, a legacy of last year's battle against inflation. Do these signals hint at a genuine resurgence, or are we merely postponing the inevitable plunge? Tariffs and interest rates are a big part of the picture, but what about the surging national debt? The national debt is growing at an alarming pace. It surged past $33 trillion back in late 2023 and has now blown by $36 trillion in early 2025. Imagine spending so much that your credit card bill doubles, then triples, and you keep spending. That's the path the US government is currently on. This year alone, we're expected to pay around $952 billion just on interest payments. That's like paying off only the interest on your credit card without ever reducing the actual debt. The worst part is that this money isn't available for building roads, educating kids, or improving healthcare. It's simply going to pay creditors. The current trajectory is unsustainable, and eventually something has to give. Now, let's get real about jobs. Yes, unemployment is low, but recent layoffs in tech and finance sectors show that cracks are appearing. People are starting to feel uncertain, asking, is my job safe? If this uncertainty spreads, it could quickly become a domino effect. Think back to 2008. Job losses started small, then spiraled quickly. Could we be seeing the early signs again? And here's the tricky part. This isn't just a US issue. Global factors are throwing fuel onto the fire. The war in Ukraine is still raging. Supply chains are under strain, and China just retaliated with its own tariffs, escalating trade conflicts. Each event might seem distant, but the global economy is deeply interconnected. A price spike halfway around the world means higher prices here at home. So, what happens when global tensions meet aggressive US trade policies? History gives us a clue, and it's rarely good. Yet, despite all these warnings, American consumers keep spending. Last holiday season, we set records by spending over $700 billion. Sounds great, right? But there's a catch. Americans aren't just spending their earnings, they're dipping deep into savings and piling on record high credit card debt. Now, over $1.2 trillion. Think about your own financial habits lately. Have you noticed you're relying on credit cards more? Or perhaps your savings have shrunk dramatically? You're not alone. Millions are in the same boat, facing rising interest rates and shrinking safety nets. This is exactly why the next few months are so critical. Economists warn we might be hitting a tipping point, a moment that could push our delicate balance over the edge. We may be nearing a critical turning point with the newly ignited trade war. The tariff shock of early April could prove to be the match that lights an economic powder keg. Businesses cut back, hiring slows, layoffs increase, and consumers, already strapped with debt, reduce spending sharply. Suddenly, we're not just looking at a slowdown, we're facing a recession. Wall Street strategists note that equity markets are already pricing in about a 40% chance of recession, and that was before the full tariff impacts. Should tensions escalate further, we could see a sharp market sell-off. It's a scenario reminiscent of past episodes like the 1970s oil embargo or 1930s trade wars, where policy missteps turned economic jitters into an economic earthquake. Or perhaps the tipping point comes from our massive debt. While the US can currently finance its deficits, cracks are appearing. What happens if investors lose faith? In 2023, Fitch downgraded US debt from AAA, citing fiscal deterioration. Now, in 2025, Moody's warns of a multi-year decline in US fiscal strength, projecting debt to rise from nearly 100% of GDP today to about 130% by 2035. If our credit rating slips further, borrowing becomes costlier, interest rates spike, and we find ourselves trapped in a cycle of borrowing to pay off borrowing. Sound far-fetched? It isn't. Countries have faced this before, and the consequences were dire. And here's the most unsettling sign yet, the infamous yield curve inversion. This indicator has predicted every recession since the 1960s, and it's been flashing bright red for a record length of time. Economists are openly discussing a recession by the end of this year. Could we already be on the edge of the cliff without realizing it? Look, none of this is guaranteed. Economic disaster isn't inevitable, but ignoring the warnings won't make them disappear. Key fundamentals that once powered the economy, like confident consumers and manageable federal debt, are eroding. We have an economy that is still growing, but under increasing strain from high interest rates, global turmoil, and risky policy choices. In a worst-case projection, a few years down the road, the US could face painful austerity measures, a loss of global economic leadership, and a lower standard of living as debt and interest costs crowd out investments in our future. Leaders still have time to act. Resolving trade disputes, getting spending under control, and managing inflation wisely could steer us clear of disaster. But we need to act soon. The choices made in the coming months will set the stage for our economy and our everyday lives for years to come. Now, I want your opinion. Are you worried we're heading towards economic disaster, or do you think these risks are exaggerated? What concerns you most? Job security, inflation, or rising debt? Don't forget to like and subscribe if you found value in this discussion. I appreciate your support.